This is the Wealth Ability for CPAs show. Better clients, better practice, better life. Here's Tom Wheelwright.
So the Supreme Court is about to take up what could be one of the most dangerous tax cases since Wayfair. And it is the Moore case. It is a case that the entire tax professional community is watching, and we're here to kind of dissect it and what the potential outcomes could be, what the potential ramifications could be. And I'm gratefully here with my friend Garrett Watson from the Tax Foundation. They have done so much research written about this. And Garrett, it's always a pleasure to have you on our podcast.
Thanks for having me. Excited to chat.
So, Garrett, if you would, let's just start right off with what are the facts of this case? What happened, and how did this end up in the Supreme Court?
Sure. So, yes, a few months ago, the U.S. Supreme Court granted cert to the case Moore v. United States, which is currently now basically in the brief submission process by all the parties. The Moores, the plaintiffs in this case, have submitted their brief, and there are now friend of the court briefs and other briefs being submitted. It will be heard before the court, likely, I believe, later this month or early next month. I don't believe it's been formally scheduled yet, but that will be coming. And it's anticipated that a decision would be sent out by the summer, likely by June, as part of the Supreme Court's broader list of cases they're taking this session. Long story short, this case, as you just mentioned, Tom, is really could be a very pivotal one for the tax policy and community, for the tax practitioner community, and anyone who's working through sort of the broader tax space. And that's because the Moores are making potentially a case that could have ramifications across the tax system. Specifically, they're looking at, as part of the 2017 tax law that was passed in December of 17, we basically had a pretty big reform of particularly of the corporate tax system, or a broader business tax system internationally, where we moved from having a worldwide form of taxation, moved closer to a territorial system. The idea behind that being that was more consistent with the way in which other countries taxed international business and made the U.S. more competitive. But as part of that, as many folks know here, but just as a review, there were a lot of foreign earnings that were domiciled abroad that were not subject to tax under prior law that Congress wanted to encourage to come back to be repatriated to the United States. But they wanted to balance that with the fact that this was previously untaxed earnings that should be subject to some tax, and they wanted to come to some grand bargain. This has happened in the past, including, I believe, in the 80s, where there was some repatriation as well. So they came up with what is known as Section 965, the deemed repatriation tax. It's also commonly known as a transition tax, where folks with earnings abroad are subject to tax, though at a rate lower than the statutory rate, and it depends on the whether or not it's liquid, right? There's several rules related to that, but the important part of that is it was deemed, meaning it didn't matter where the physical location of these earnings were. If you left them abroad or you brought them back, you're going to end up having to pay tax. Notably, this impacted both, of course, impacts C corporations with earnings, but also, of course, impacts shareholders of folks who may have some exposure indirectly from this deemed repatriation. And that's where the Moores come in, where they have, go ahead.
Let me ask you a question on that. So the Moores aren't the ones it's not the shareholders being taxed, right? It's the company being taxed. So the Moores themselves were not being asked to pony up tax.
Right. So they own shares in a foreign, I believe it's an Indian-based company, Kiss and Craft, which itself has some deemed repatriation tax owed. And the argument is that despite the fact that they are have ownership here, they have not realized any income, right? They're merely owners, but they are getting some impact on their overall income from the company indirectly, right, as shareholders, because of this deemed repatriation tax. And so basically it comes down to whether or not this could be considered a tax that is direct, that has not been apportioned, that would therefore not be constitutional. And that's basically the very long story short on the legal basis for their case, is that 965 is something closer to a wealth tax than a traditional tax on earnings from pass-through businesses that we typically see. And so, and just to finish up the recap here, this was taken before the Ninth Circuit. Tom and I were just talking about this right before the recording, which basically what happened there was they were very skeptical of the Morris claims and had a very sort of sweeping interpretation of the authority of Congress and others to set tax law that could potentially be used as a way to justify even wealth taxation under current law. That might be part of what's going on here is a reaction to that. The last thing I'll mention real quick is there's really two issues here that are related but still distinct. One is on realization and the question of what is realization in the context of this particular arrangement. But the second is also on control. I think that matters too, right? The definition of what control means, because Congress, not just here, but also in, say, subpart F rules and other rules, have defined control in a way that is specific to countering avoidance in the tax code, meaning very specifically what they wanted to avoid was having a bunch of shareholders, each of which having minority control, banding together in the U.S., getting majority control, and then using that to avoid tax. So they've actually defined control in a way that says, hey, even if you're a minority shareholder, if you are with other U.S. shareholders that constitute a majority, that for purposes of subpart F and other anti-avoidance rules constitutes control. And there's some questions there as to whether or not that makes sense, but that's often sort of juxtaposed or overlapped with this realization question.
Got it. So thank you for that summary. So let's kind of back up a little bit. The Ninth Circuit. So the Ninth Circuit, the way I read the Ninth Circuit decision is they basically said Congress can do whatever it wants when it comes to tax. Is that fair? Is it that broad?
I think it's closer to that summary than the alternative. I think for sure, in that they and it's been pointed to that this Ninth Circuit decision could open the door to a variety of taxes that would traditionally be considered folks would be very skeptical of from a constitutional basis, particularly as it relates to taxes on wealth. Because, and this is something that's been dealt with at the state level as well, because you can try to creatively interpret certain taxes to avoid it being a direct tax on wealth. Most notably, I believe it was in Washington state where they tried to interpret where they can't tax income. Instead, they reinterpreted it to mean it was an excise tax on doing business, even though it had all the traits of taxing income. So there are ways to reinterpret these things.
I think there's a very big question whether that Washington capital gains tax is constitutional. So
yes,
that's another case that I'm sure that we'll be watching. And Washington, I'm sure, is watching the Moore case very carefully, yes. Because they have, I think, some issues, similar issues. So here's a question I've got. So isn't every corporate tax basically a tax on wealth? I mean, how because the Supreme Court has held that corporations are persons, right? They're not individuals, but they are a person. We had a case a few years ago where the court held that the corporations have rights as persons and taxpayers, and so even though they're owned by individuals. Do you think this is pretty easy for them to say, for the Supreme Court to say, well, this is really narrow here and look, and actually hold against the Moores while still saying that you can't have, a tax on unrealized income, because the reality is it's not a tax on them. It is a tax on the corporation. And if the corporation is a person, I believe it was the Hobby Lobby case where the Supreme Court said, well, look, Hobby Lobby is a person. They have rights as a person because they're a tax-paying entity, and you don't have to go to the shareholders. It's not just the shareholders have rights, the corporation itself has rights. And so could the court, do you think, distinguish just based on that alone?
Yeah, I think you're onto something there where I think there is an opportunity for the court to basically take the line that reminding folks that are arguing that presumably in a majority opinion that the Ninth Circuit's interpretation is very broad interpretation of the ability of Congress or other policymakers federally to enact wealth taxes or taxes that are very close to wealth taxes that are creatively reinterpreted are not constitutional, likely not constitutional. That's just reaffirming something that we've most folks in the legal and the tax law space generally agree with. Of course, not universally, but that's generally been the commonly accepted understanding, sort of reaffirming that and casting doubt on what the Ninth Circuit's interpretation, while also simultaneously not completely knocking out the existing system of business taxation that we have in the U.S. That includes 965. That also includes the way in which we tax corporations, which as you just said, I mean, it's I do think, even though there is some when it comes to the impact on shareholders, realization-based impacts, right? Overall, when we tax C corporations on the basis of their net earnings, it's on the basis of their income. It isn't. It is fundamental, and that's something that's been understood in the history of tax law.
And it's realized income.
Say that again.
It's realized income.
Exactly. Yes. And then ultimately the shareholder, in the form of the impact on dividends, and then ultimately the capital gain or loss that they take when they decide to sell, sees the impact of that. Of course, some combination of shareholders and workers and others. And so that, but that fact we shouldn't muddy things, right, by trying to conflate these two things. And I think the risk is if the sort of more maximalist sort of view wins out, in the hope that would rule out a wealth tax, it could also really disrupt business taxation.
Yeah. So let's talk about that for a second. Okay. So specifically, some of the commentators have suggested that this might interfere with the way partnerships and S corporations are taxed. And because obviously, so Moore's had what, 13%, I believe, right, ownership. And so they're minority shareholder. They really have no control. I mean, the reality is, in fact, they've forgotten about it completely, right? And until they get the notice saying, hey, by the way, just know that, this is going on. I'm not sure why they would have gotten a notice as a shareholder, but they apparently did. And obviously the courts felt like they had standing to file this suit. That was not thrown out by either the original court or the Ninth Circuit. And clearly Supreme Court has said, yes, they have standing, else they could have thrown it out too. But let's look at this S corporation and partnership, because that's one of the arguments is, well, wait a minute. If you decide in favor of the Moores, not only do you eliminate all the tax that was collected on the repatriation tax, which is an enormous amount of money, because it's like $2 trillion, I think, that effectively was being taxed, something like that. I think.
Yeah, it's something like, if the whole thing were, struck down, including retroactively, it's several trillion actual earnings. The total amount of tax was somewhere around 350 billion.
Yeah, so that's what I thought. It was an enormous amount of tax, and it was less because of FDII and all the things they did to give them, basically make it easy for them to pay that tax. Right? Look, we just bring the money back. We want the money in the U.S. We want it functional in the U.S. My take on actually that law was I think the corporate provisions in the 2017 Act were the best provisions of the 2017 Act, both the reduction of the tax rate as well as going to a territorial. I think the FDII guilty regime is not a bad regime. I mean, it's complex, but it's not a bad regime. And it seems to have worked just fine, actually, which is, really interesting. But again, one of the questions is, when you have commentators saying, well, this could affect partnership and S corporations, there are lots of minority shareholders in S corporations, lots of limited partners in partnerships that absolutely get a tax liability that's frankly far more egregious than what the Moores had. I mean, the Moores, all it affected was technically the value of their stock, but the reality is it didn't affect them directly at all. It was the corporation. If you can separate the person from the shareholder from the corporation, the Moores have no case, which I think is part of what the Ninth Circuit was suggesting. But with an S corporation, let's say a non-voting shareholder or a limited partner, they don't have any vote, and it is a tax on them. So how do you reconcile that?
Yeah, I think that's right, and that's exactly why I was pointing to this. There's a separate question that's come up about control, which is part and parcel of this, right? Which is, we have a broader system of defining, controlled foreign corporations and subpart F for international sort of tax liability calculations in the U.S. And That was defined statutorily, where, as I outlined earlier, right, you can have individually minority control, but the definition of control for purposes of entering into that regime is not consistent with the intuitive definition, right? And that's precisely because they defined it as control amongst all the U.S. shareholders, not just individuals, even if there's no relationship. And that was done in Congress to ensure that folks couldn't, collude or work together to, in the context of a foreign controlled corporation, to avoid tax. And so, but the big thing there is, and I think the thing that's sometimes missed, and this is something George Callis, former tax counsel on Ways and Means, was very integral to building out a lot of the 2017 tax law rules. He pointed out that that the definition of control is a statutory one. It's not one that's constitutional. The realization question, the question of whether or not something is a direct or indirect tax, is a constitutional question. And depending on your interpretation there, you can create a consistent, at least an internally consistent case for why 965 or these other things are not constitutional. We may not agree with it, but the control question is sort of can be a bit of a sidetrack, because it's a statutory question. It's a question of interpretation, but arguably there's no constitutional question there, because Congress has the statutory authority to define control however they like. And so you'd have to create some sort of constitutional question for why that matters in the context of 965 and these other things. I also want to mention, of course, and as we outlined in our piece at Tax Foundation, and as others have pointed out, including Mindy Hertzfeld at Tax Notes, there are a variety of other things, including Subpart F, CFC rules, mark-to-market rules are also.
So let's get to that, but let's just for a second, let's clear up the S corp and the partnership. If they decide that, because saying, you have the control issue, that would be one of the Moore's arguments. Clearly, we didn't have control over this. But then at the same time, how can you rule for the Moores and rule against and not rule for partners, limited partners, for example, because they are taxed, right? And they are not getting the money.
Yeah, this is how the dominoes fall, right? If you start accepting the core premises of the Moores, it's hard to know what is the guiding principle by which we stop, right? You can, I think, create a middle ground where you're talking about, hey, wealth tax, the Ninth Circuit's interpretation and wealth taxes are still not constitutional. That's fine, but the rest of this is preserved. But yeah, once you start asking the questions about whether or not 965 is constitutional, the rest of it is very hard to separate out, right? And this could, knock out a ton of related provisions that have very similar structures.
Could they look at just the realized versus unrealized? Because very clearly, a limited partner realizes. I mean, that's income that's been realized by the partnership, right? That's income that's been realized by the S corporation. And could they go straight to the realized, unrealized? So let's talk about the realized, unrealized, because we have unrealized taxation in the law. We have mark to market rules in the law, which is unrealized income. So how do you reconcile that with I know you guys have said no, wealth taxes are unconstitutional. I believe you said that. And of course, we all hope they are, because none of us want a wealth tax because it's the worst kind of tax. But how do you reconcile that mark to market with a realized versus unrealized? Do you throw that one out?
Yeah, I think once you start, deciding that this is the 965 is thrown out on the basis of realization, that is exactly when it starts imperiling these other aspects of the tax code. Mark to market's a good one. I think the broader Subpart F regime starts being under question. There are even questions about whether or not maybe the book minimum tax that was recently passed could be complicated, because there are, of course, you're talking about using a different set of books that many of which have stuff that's on the books that isn't realized, right? And so. The ball of yarn here starts unwinding very quickly. And I think that the underlying sort of policy theory here, sort of setting aside the legal stuff real quick, is the hope is maybe this is an opportunity to be, yes, disruptive with the tax system, but in that sort of disruption, we could create something better. The problem is, historically, we really haven't seen that in tax or elsewhere. When you create a lot of chaos and disruption, it could result in a system that's the worst of all worlds, or even worse than we currently have.
So I think Brazil.
Exactly. So I think prudence here on the part of, the legal merits are the legal merits, and then the justices will decide that. From a policy perspective, trying to introduce disruption for the sake of trying to, push the ball forward may not turn out the way in which those advocates might hope. And I think that's the worry on the part of folks who are worried about this case.
Okay, so one thing they could do is they could do realized versus unrealized. They could certainly make that argument. And though it's tough because we have so many years. I mean, mark-to-market rules aren't new. I mean, they've been around for years and years and years and years. Most, if not all, of my career. And so how could, because if you look at the Supreme Court, they took this case up for a reason, right? They didn't have to. They could have just said, nope, not good enough facts. Kind of like they did with Jeffrey, right? Jeffrey was one of those cases. They go in the state tax area. They go, I don't think the facts are good enough. They waited for Wayfair, frankly, and Wayfair had better facts. And so it was a cleaner case, and end up with actually a fairly clean decision. I thought in Wayfair. But in this case, how would they deal with this without just saying without just having in dictum, just in their opinion, say, well, this doesn't mean a wealth tax, because they could say that, right? They could rule against the Moors and then in the opinion say, well, wait a minute. Okay. This is what this is. And this is not a wealth tax, and a wealth tax doesn't mean a wealth tax would be constitutional. Get out your crystal ball, Garrett. We're coming up on Halloween. What do you think?
Yeah, I think for folks who are skeptical about this case, that is their hope, is that this is mostly a reaction to what the Ninth Circuit was saying, and they and several of the justices wanted to get their views out there, and that there won't be a major shakeup more broadly based on the Morse case. That said, I think that's far from guaranteed. We will see a lot more. I think we'll be able to sort of forecast more potentially once we start seeing hearings and questions from the Supreme Court justices. That can often help. It's never a guarantee about where things might shake out, but that can often reveal where certain justices are leaning based on the nature of their questions. Even things like body language and voice intonation can help on that. But I think you're exactly right. I mean, the court took this for a reason, and the question is that reason more substantive than just a reaction to the Ninth Circuit? And the question is on what is the legal framework or basis we're going to see them sort of start and stop? And as we just mentioned, right, I think and I think as we've seen in some of the legal analysis from folks, that can be pretty challenging to figure out that forecloses at minimum at least some disruption in the business tax regime in the U.S. And so hoping to see more litigants fall on this based on those questions. The other thing that's come up a lot is this is a court that doesn't have a lot of tax law experience. When you look at the history and biography of many of these justices, of course, extremely smart and accomplished individuals, but that also is an interesting fact that will might mean that a lot of the briefs that come in and arguments are going to matter a lot. And we're seeing this many briefs being submitted as friends of the court or for one party or the other. And so that's another place I think to look to see the array of arguments that are going to be cast. And we already, of course, have the Morse brief, so that's been helpful to see where they're going, what their line of argumentation is. We'll see what follow-up questions the court has when they start talking in court.
So what's their primary argument
on the part of the Morse?
Yep.
Yeah. So I think it comes down to this question of whether or not this particular tax is a tax on income that would be valid under the U.S. Constitution, or it's closer to a tax on wealth, right, and more a direct tax that has not been apportioned. And of course, structurally, it'd be very hard, if not impossible, to change this so that it is apportioned. So functionally, it would just be struck down and not reversed. And so that's that. And questions, in fact, and the facts of whether or not there's control here is another aspect of this, which is why we were mentioning that earlier, because that has come up. And what the Morse are doing here is they're sort of again not just laying the groundwork for questioning whether or not this particular tax is closer to a tax on wealth, whether or not similar taxes might be. And I think one interesting comment, I believe, I don't know if this is in the brief or elsewhere, was that it's not clear to me that is the intention of the Morse, is to have a maximalist sort of view to sweep clean much of the business tax system. But as we've seen in many other cases, the intentions of the plaintiff or of any particular party in a case are not necessarily what end up actually happening, what's decided by the court. Of course, the court can, the other option we haven't talked about, of course, but they can sort of punt or not make definitive judgments on a lot of this, right? I think, sometimes we might connect dots in our minds, but the justices don't have to do that. And that's often a tool that you'll see in a lot of these cases, not just in tax law, but elsewhere in the Supreme Court, where they just aren't going to make a definitive judgment on other things, even if, in our minds when reading it, it seems like you could connect A to B to C. They may try to do something very narrow here and leave any other questions to other cases, which might mean that we might see follow-up cases years later on this, on related questions, and that might invite further litigation. That is something else the court will have to decide as to when they balance what the right judgment call here is on the given the facts of this case.
For sure, this could absolutely open the spigot. Final question. So this can't be much of a tax for the Moores because there wasn't much of a profit. So who's behind this? Because it's clearly not the Moores by themselves. It's way too expensive to bring a case like this. So who's paying for this? Who's promoting this?
Yeah, I'm not sure. Of course, I don't think there's any sort of public accounting of who's paying for it. I know the attorney of record and the folks who are helping, of course, is Competitive Enterprise Institute has done a lot of work on this, and I think that goes back to this question of like the more narrow facts of this case, and then more broadly, I think there is sort of an opportunity for some folks who are pro Moore or more in the case of like, hey, we need to see some disruption in the tax system, is foreclosing the wealth tax discussion for good, because I think that's going to continue to be a discussion. And there are legal theorists out there, particularly left-leaning folks, who argue like, no, actually, we can make this fit into the existing system. And then also, this idea that I just mentioned earlier, which is, if we can create an opportunity for some disruption that might help create something better, I think that can be a challenge given the how that's worked out historically. But the So I think that's probably what the motivation is here, right? Of course, a lot of folks may just, I think there are legitimate thoughts that this particular tax, more narrowly, was not well structured. I think people did sort of bristle at this idea that, hey, Congress just comes in and just deems this repatriated and institutes an income inclusion rule. Though that's not, to be clear, historically anomalous or inconsistent with what we've done in the past. A lot of the other rules in the international tax regime, including GILTI, are income inclusion rules. A lot of the discussion in the Pillar 2 discussion with the OECD include income inclusion rules. So that's probably just another way of going back to what we talked about earlier, which is you start asking questions about one part of this, it's hard to say, what is the limiting principle by which we stop there? But of course, that's not something for the plaintiffs. They're just looking to resolve their case. Whether or not that knocks down other things is not necessarily something that they need to take on themselves. That's the responsibility of the court to determine and figure out, given, if you apply a fact or circumstance here and it applies elsewhere, that's on them to do, and then on Congress to fix the laws if indeed something is unconstitutional.
Oh, thank you. So thanks, Garrett Watson. Please go to taxfoundation.org. There's an enormous amount of great information. They do an amazing analysis, not just on Moore, but on state taxes, on taxes, on the global minimum tax, which I have a very hard time with, mostly because I think it's doesn't do any good for anybody in the U.S. And it's like, why are we giving away profits from U.S. corporations to other countries? Makes no sense to me. That is a discussion for another day. Garrett, would it be okay if, as this progresses, that we get you back to do an update?
Yes, we'll be happy to update. And yeah, this will be a fast-moving case in the next few months.
That'll be awesome. So just remember, everyone, we have to pay attention to these court cases because they don't just have a ramification. They have a ramification on our clients. They have a ramifications for our practice, our business. Can you imagine? The tax preparation softwares even dealing with this, this kind of a disruption? Just learning GILTI and FDII was hard enough in the first place. Now, there's potential of throwing them out. Do they come in and say, well, then we're going to do a value-added tax because value-added tax is an indirect tax, we don't have this issue, right? That's clearly an allowable tax. I think a value add tax, just like a sales tax is, and we could do it that way. So there's so many ramifications from this Moore case, and I would encourage everybody pay attention to what's going on, and let your clients know, because our clients need to know what the potential is. I don't think I suspect it'll be a more narrow view, because courts tend not to like to disrupt the fisc. They don't like to generate refunds. I found in state courts, federal courts, they do not like to generate refunds for broad classes of taxpayers. And with that, hopefully we'll get something a little more narrow, but maybe get some good definition out of this, and we'll follow it as we go. And as we explain it to our clients, kind of keep them abreast, our clients will be so appreciative of it. Remember, the more we do for our clients, we always end up with better clients, a better practice, and a better life. We'll see y'all next time.
You've been listening to the Wealthability for CPAs show. Better clients, better practice, better life. To learn more, go to wealthability.com.